Это очень информативно. Вот то, что вы пишете в интернет и сейчас. Я прям вообще балдею от количества информации, которую вы выдаете. Вы даже не в состоянии понять, что было последнее. Хорошо, какой был последний слайд? Ну, раз никто ничего не слушает. 16-й. Зашибись. Okay, so the last thing we had discussed was how to estimate the change in portfolio price in case we know the change in rate. As I can see, let's move to the next slide. We discussed here the duration and convexity of the bond. So here to apply this construction and to estimate the duration and convexity of a bond using these formulas, because as you can see here, it's about the weighted duration. At this moment, we are assuming that interest rates to all the terms will be equal. So this assumption underlying the formulas you can see here on the slide. I think it's quite clear. In case this assumption does not fulfill, we will have a problem. So pay attention to this fact. We need to make this assumption. As I can see, I don't see it, but please make a special notation here. This is about the application of these formulas. This is very important, and to use it, pay attention that we are assuming that all risk-free interest rates are equal to all the terms, and we are assuming they are equal to R. In this case, and under this assumption, we can calculate the duration of the portfolio and the convexity of the bond portfolio using the following formulas. Under this assumption, we also can say that the duration of the portfolio will be between maximum and minimum duration of the assets which are part of this bond portfolio. And the same statement will be will work in case for the convexity also. Also pay attention to the fact number 3, which is very important. We are supposing and that for any, we can choose any number of t, which is between minimum and maximum duration. And in this case, we will be able to construct the portfolio so that the duration of the bond will be equal to this number. This is very important notation. Here, as I told you before, I didn't write the assumption. In case of Russian groups, I suppose I did it, so sorry, I forgot it in your case, but make a special notation that all this construction will work only in case when all the risk-free rates will be equal to R for all the terms. Okay, and now let's move to the bond immunization strategy. Here we have 4 assumptions. We are assuming that all the risk-free rates are equal at the initial moment of time for all the terms. Actually, it means that the term structure is flat. The term structure is flat at the initial moment of time. We're also assuming the term structure can change, but the step will be the same to all the rates. Doesn't matter which term we will take into consideration. We're also supposing that bonds can be bought or sold in any quantity without transactions cost. It's absolutely unreal assumption because in real life you are not able to buy or to sell 1.5 bonds, for example. But to implement the theoretical part of this case, we will take this assumption under consideration. To implement the real part, we will you will have to make the choice. Also, we will suppose that any sums of money can be invested at the appropriate risk-free rate at the moment we will get it. So this is very important assumptions. Wait a minute, please. Да. А ничего, что вы на лекцию звоните? Ладно, что случилось? Но если они из 100 баллов пишут, то да, не надо. Вообще без вопросов тогда, да. Конечно. Это вообще не проблема. А на эту пересдачу-то, это моя пересдача будет? Точно никто не придет? Ну, потому что я-то приду, у меня же ДПО. Я-то здесь все время торчу, и мне не хотелось бы там с кем-то лбом столкнуться. Ну да, то есть много аудиторий. Да, конечно, ставьте, не проблема. Договорились. Угу, давайте, да, счастливо. До свидания. Так, это ваш деканат. Так, что мы тут проходили, я уже забыла. Так, окей. So let's move to the next slide. And what is the goal? We assuming that we want, we are putting forward, actually, we are estimating the goal of our investment. Actually, here should be, we should make some changes like this. In case we're assuming we are investing n times per year, actually here will be like this. And we want to get the sum anyway, because the risk rates can change. In real life, they will change. And we want to get the sum, this planned sum. At the initial moment of time, we are estimating the sum we want to get using this formula. This is the general formula of compound interest, nothing difficult. And we want to get the sum. So this is our initial sum of the investment. This is the factor we are using to estimate the sum. So this is our time horizon. Okay. First of all, when you want to solve a task, you should determine the time horizon. To define this number, you should use this assumption. And first of all, I will remind you, will choose the bonds from the bond you have. At this moment you have 7 bonds, so you should choose part of them so that, and the number of bonds in your bond portfolio when you're going to implement the immunization strategy should be not less than 3. And you should make at least 2 rebalancing of the portfolio. So in case you want to choose, it doesn't matter which bonds you will take from the 7 bonds you have at this moment. This is how to choose. Next, you should use this theory to define the time horizon. Let us suppose you did it and you stand your time horizon as capital T. When we are ready to implement the immunization strategy, how does it work? Really, from the previous lecture, you know about the immunization property of the duration of the bond. What we are doing to implement the strategy? We are forming the portfolio so that the duration of the portfolio, weighted duration of the portfolio, will be equal to the time horizon. Also, we are supposing that the sum of the weights is equal to 1. Do not forget that short sales are prohibited. That is why the weights will be non-negative. So this is how to find the construction of the portfolio, the allocation between the assets. Okay, so we did it. Now we are moving to the next step, and the next step will happen in case our bond portfolio will make the first payment, the first coupon payment. In case there is no change in interest rates, you should do nothing, just reinvest the coupon. In case the rates will change, you should construct a new system and make the rebalancing of the portfolio. How you will do it? Let us suppose at time moment T1, the rates will change. Your time horizon will move to the next step. You will calculate the new weighted duration. The sum of the weights also will be equal to 1, but here will be new weights. And applying this idea, you will form a new portfolio. You will recalculate the old portfolio to the new one. You will make the reallocation of the assets. Okay. If at some point in time will be impossible to form a bond portfolio with the required duration, we should solve the bond portfolio, and in case we didn't reach the time horizon, we should put all the sum we get after the selling of the portfolio. We should invest it at the current interest rate until at the end of the time horizon. This is the idea how the immunization strategy will work. Now I will explain you briefly how it can be implemented in real life. Okay, what should we do? Let's consider the example. First of all, let us suppose we have the two bonds, and we had formed a portfolio using these two bonds. The current price of the first bond is equal to the current price is equal to 100, is equal to the face value due to the fact that the internal rate of return is equal to coupon rate. In this case, if you will go back to the property of the rates of the bond, the current price will be equal to face value. Let us suppose we have a sum of $1,000 we are investing in these bonds. You can calculate the duration of the first bond and of the second bond. If you will do it, you will get that the duration of the first bond is a bit less than 2, and the duration of the second bond will be a bit less than 4. That is why it's possible to take the time horizon of investment equal to 3 years. And the question will be the implementing of immunization strategy in case the rates change twice in half year after the beginning of our investment, and in 1.5 years. So what's the idea of the solution? The idea is very, very simple. First of all, you are calculating the appropriate sum of the investment. How it can be done? You will do it using this formula, where omega is equal to 1000, the R is equal to 8%. The interest is calculated, I don't remember, but I think twice per year. So M will be 2 and T will be 3. It allows us to estimate the planned result of our investment, it will be this number. As we can see, during our time horizon of investment, the rates will change twice at 0.5 years, at 1.5 years. What should we do? First of all, we should form the system like this. You will calculate the duration of the first bond, then the duration of the second bond. This is of the first one, and this is of the second one. So you are solving this equation, and you will find the first portfolio. Okay. When you calculate this portfolio to a particular bond, you will get the current price of this bond will be equal to 1,000, the initial sum of the investment, and you will be able to estimate the current price of this bond at the moment T1, which will be in 1 year. The sum will be equal to this moment. You will calculate duration, you will get the new system, and you will make a rebalancing of the portfolio. After you will do it, you will get the new bond with new cash flow. Okay. Next time moment will be in 2 years, but in 2 years will be not possible to make the new rebalancing, because in 2 years the first bond it will be the date of the maturity of the first bond, so it will be not possible to make the reinvestment. That is why you will have to send the bond. The estimation of the portfolio at this moment is equal to this number, so you just selling it and put this sum at the current rate. And after you will do it, you will get this result. As you can see, the real implementing of the strategy allows to get this result. So my question to you, shall I show something in Excel, or everything is clear? Okay, you have two bonds, A and B. Okay. Rates are equal to 8%. One time per year, so M is 1. Okay. The coupon is equal to I think it's better to take 1,000. Okay. Actually, we know that the initial sum of the investment omega is equal to 1,000. We know that at the initial moment of time, the rates are equal to 8%. It means we have the internal rate of return. So the coupons are equal to 8%. So here are the payments. Okay. like this. This is the initial construction, and we know that at the initial moment of time, the rates for any time is equal also to 8%. In this case, when the rate is equal to coupon rate, the current price will be equal to the face value. I'm not going to calculate this. You can check if you want. So you have a construction like this. To calculate the duration of the bond, I remind you, you should calculate the discounted cash flow and multiple it to the corresponding time period. Here, the initial rate is equal to 8% for all the terms of the investment. That is why you will have a payment divided to 1 plus rate, which is equal to this number, divided to m, which is equal to this number, and the degree will be equal to the time multiple to m, like this. Will be absolutely the same situation. The payment divided to 1 plus rate, which is the same, divided to m, and the degree is equal to the time or period to m, like this. So to find the duration, I remind you, you should multiply the discount. You should multiply it to tk according to the formula on the previous lecture. Actually, it will be equal to this number multiple to corresponding tk. You will have like this. In this case, you should do the same step. You should multiply it to tk. And to find the duration of bond A, you should summarize these terms and divide it to current price. As you can see, it's absolutely equal to the number I have shown you here. And the duration of a bond B will be absolutely the same approach. We should summarize the discount cash flow multiple to the time and divide it to the current price of bond B. And of course, we got this number. Good, now we are ready to form a portfolio with weights 1 and weight 2. What should we do here? We should form here will be the weights in these cells. Now let's make the equation duration to the weight plus duration to the weight, and it must be equal to the time horizon. The initial time horizon is equal to, let's write here that the initial time horizon is 3. So here you should make it equal to this one. Also, we know that the sum of weights, so this plus this, it will be equal to 1. And that's all. So you should go to the solver. And for example, sum of the weights here, it must be equal to 1. You are changing the cells and you want to add the additional equation that duration of a bond portfolio must be equal to this one. Do not forget the weights must be non-negative, and that's all. So you have the weights at the initial moment of time. It means this sum of your investment must go to the first bond and this sum must go to the second bond. Everything is clear. I hope so. Nothing difficult. We just had, at this moment, we just had constructed the first portfolio. If you want to find the sum which should be invested in the first bond, you can calculate this sum will be equal to total sum multiple to the weight. And here you should multiply this sum to the weight. We have found. Now you can find the cash flow if you want of your bond portfolio at the initial moment of time, which is formed from your bonds. So here, what do you have? We need to calculate the sums here. What do we have here? We know that we have the sum invested in the first bond. Its current price is equal to this number. We also know it pays 8. About the second bond, we had invested the sum. This is the current price, and it paid also 8. So here will be 80. Let's calculate how much here. We had invested the sum. It costs 100, and it pays this sum plus the sum of investment to the current price multiple to the payment. Sum of the investment, but okay, no, so only this bond, sum of the investment to the current price and to the payment. Sum of the investment to the current price and to the payment. That's all. So this is the future cash flow in our bond, no problem. This is the construction we are investing in our bond portfolio, nothing difficult. What should we go? What should we do next? We should go to the task. And as you can see here, according to the theory, in 0.3 years, rates change to 7%. In 1 year, it doesn't mean that at this time moment you should do something. You shouldn't. You should do something only in the moment of the coupon payment. The nearest coupon payment after this moment will be in half year. So the nearest coupon payment will be in the 1 year. So the rates will change and all of them became equal to 7%. Okay, let's calculate what will happen here. but we will do the next step. In 1 year, we should first of all estimate our sum of investment, but the rate here now is 7%. The rate is changed, but we are in 1 year from the very beginning. It means that if we are in 1 year, our construction in time had changed, because in 1 year, after the very beginning of our investment, we will have the following situation. So we will have this rate, and we will have this construction. At this moment, this part will represent future payments, and this payment we will get at this time moment. So here is t is equal to 1 in 1 year after the beginning of the investment. Let's calculate the sum which we will get instead of omega. At the initial moment of time, we had invested 1,000 of money. What do we have in 1 year? In 1 year, we will have the sum which will be omega 1, and it will be equal with sum which we will get clearly, and this part represents the future payments, which is why we should discount them using the current rate. But the current rate is equal to 7%. And let's calculate the discount of future payments. So it will be equal to this divided to 1 plus the rate divided to m. The m remains the same. And here is the time multiple to m, which remains the same, of course. It will not change. And you will get, at this time moment, the sum you will get clearly as a coupon payment and plus sum of discounted future payments of our bond portfolio, like this. So you will get this sum, like here. As you can see, absolutely the same as I have shown to you. So this is the sum we will take at the moment in 1 year. This is our very particular bond. And this is the sum we have at the moment in 1 year success. In 1 year, future payments will be in 1, 2, and 3 years because we had moved in time. Okay, what will be the payment? We will have here this, what is the discount? Discount is equal to the sum divided to 1 plus the rate divided to m, and the degree is equal to time multiple on m, which remains the same, of course. The u1. Next, we should multiply with discounted to tk. Good. To find the current price, in 1 year, you should summarize all discounted cash flows. And to find the duration of the bond, you should multiple discount to K divided to current price. And to the first bond, of course, it will be 1. It always will be equal to the time to the maturity in case you have one future payment. As you can see here, 1. Here we had a bit different situation. We have these payments. We should discount them using the new rate, which is equal to 7%, divided to M, which remains, of course, the same. And the degree is equal to the time multiple to M, which remains the same. To find the current price of the bond B, you should summarize discounted cash flow. This is the new price of the bond B. Next, you should multiply this discounted payments to time. And to find the duration of the bond B, you should summarize this discounted multiple to the TK and divide it to the new price of the bond B. As you can see, you have the sum, nothing new. And you are ready to form the same construction. We should find the new rates of our portfolio and make the first rebalancing. Here will be the new rates. Okay, we should do the same. First of all, we will change the time horizon. The time horizon now we will be equal to the previous time horizon minus 1. Minus 1 because we had moved in time in 1 year. And now we should do the same. We should multiply duration to the weight number 1 plus duration of the second bond to the weight number 2, and it must be equal to a new time horizon. Also, we know that sum of weights should be equal to the number 1. Okay, let's restart the solver with new conditions. This is our function, target function. We should find new weights. We should change the additional assumption. This should be equal to this. And at this moment, we are ready to restart the solver. And we got the new weights. As you can see, they're absolutely different. Good. What do we have at this moment? We should make the rebalancing of our portfolio. It means we should calculate with new cash flow. We will have 3 future payments of our construction, and we will calculate them using this sum and using these weights. Actually, it means that we will invest in the first bond the sum which will be equal to this one, and we will invest in the second bond the sum which will be equal to this one. So at this moment, we are ready to construct the new cash flow of our bond portfolio. Actually, we are ready to do it. At which moment we should calculate this new cash flow? We should construct it at the moment of next coupon payment. according to the task, the next coupon payment will be in 1 year starting from this moment. So it means it will be in 2 years from the very beginning. And according to the task, the rates will be equal to the 6% at this moment. Good. Let's do it, actually. And let's calculate what do we have. First of all, let's calculate the new cash flow of our bond portfolio. Actually in 1, 2, 3 years, and then move in 1 year to estimate what had happened. The new cash flow, okay, let's do it in 1 year. The first bond, this is the sum of the investment, this is the current price, and the first bond will pay this sum. Good. This is the sum of investment in the second bond, this is the current price, and this is the coupon. So we will have this. In 2 years, this bond will pay nothing, only the second. Okay, good. Multiple to the payment. And in 3 years, only the second. So this is the sum of investment to the current price and multiple to the coupon. Okay. So we are ready to move to the next moment. Next moment will be in 2 years. In 2 years, we will have the following construction. The rate will be equal to 6%. And the construction, here we will calculate omega 2. And we will have the following construction. Because we will get this payment at this moment, and for this moment, these sums represent the future payments. Good. Let's calculate discount to estimate the sum we will have. Let's do it. Okay. We should multiply it to 1 plus current rate, which is now 6%, divided to m. The m will not change. The degree will be time to m, which is 1. So this is our discount cash flow. And here, to find the sum we have at this moment, we should add to the sum we just got the discounted cash flow, future cash flow. Means at this moment we will have this sum. In 2 years, you have this, no problem. In 2 years. What had happened next? In 2 years, due to the fact the rate had changed, we should, and you can see the sum here. And what next? Next, you got this sum in 2 years, but you are not able to make the rebalancing of the portfolio. So it means you should calculate put the sum under the rate to the rest of the period. So you will have the sum, and you should put it to the rest. The new rate is equal to this one. And the period is equal to 1 year because it will be the end of the horizon of the investment. So you will get this one. This is about the theory of immunization strategy. In the real life, of course, you will have a problem because what's the problem will be in the real life? In the real life, the problem will be when you will try to form this construction. Actually, if this is the current price and this is the sum we should invest in the first bond, if we will try to calculate the quantity of the first bond, we will have a problem because actually it means we should buy this amount of bond and here we should buy this amount of bonds. Of course, in the real life, you are not able to buy 3.5 or 6.5 bonds. It means you should decide what you are going to do. Are you going to buy 3 and 6 or 4 and 6 or 4 and 7? And decide how you will make your balancing. And now we will study one more strategy which you will use to provide yourself with additional sum of money. This strategy we will study at this moment is called the matching strategy. The idea of matching strategy is very easy. First of all, it's a passive strategy. It's a passive strategy. Let's suppose we need some sums of money in future moments of times. Also, we have some types of bonds in the market. The idea is to construct the bond portfolio so that the cash flow of this bond portfolio will cover our future payments totally. So, if you need some funding when you will implement the immunization strategy in the real life and you really will need the additional funding, you will form the additional portfolio from the rest of the bonds, which you did not include in the immunization strategy, from the rest part of your 7 bonds, so that the cash flow of this second bond portfolio will allow you to perform matching strategy. How to construct it in the real life? In the real life, the idea is absolutely clearly. Let us suppose you have you decided to buy this amount of bonds of each type. This will be the sum of new bond portfolio, and this will be the cash flow of new bond portfolio. This cash flow in each particular moment of time of future payments should cover your future payments. Of course, we want the sum of the cost of this new bond portfolio should be as less as possible. Of course, the weights will be non-negative because the share sales are also prohibited. Good. And that's all. I will show you a very brief example about implementing this strategy in the real life. Let's consider it. Let us suppose we have situation like on this slide. And let us suppose we need to pay 170 in 1 year and 1,000 in 2 years. We also can buy these 2 bonds with current price of $95 and $100, and they provide us with this cash flow. The question is how to construct the bond portfolio so that it will cost as less as possible and will cover our 2 future payments. How to do it? Let's do it. It's not very difficult. Actually, it's absolutely easy. Oops. Okay, we will have a construction like this. We don't know how much bonds do we need of the first type. Let us suppose it will be x1, not weight, but x, because it's just the quantity. That is why I'm not want to use the letter W. I'm using x because it's about the quantity. Okay, so this will be the total number of bonds I'm going to buy. Okay, my target function will be equal to the quantity of bond number one to the current price of the bond number one plus the quantity of the bond of the second type to the price. It will be my target function and it must go to minimum, okay? What next? I have two future payments in 1 year and in 2 years. And the cash flow of my bond portfolio should cover these sums. Let's calculate the cash flow of my future bond portfolio. In 1 year, the first bond will pay this sum, and the total coupon will be equal to the sum multiple to quantity plus this is the sum of the second bond multiple to the quantity. And this total sum must cover the sum of 170. In 2 years, the second bond will pay 100, and the total payment will be equal to this. The second bond also 100 multiple to quantity, and this sum must cover 1,000. Success. Let's start with solver. It is my target function. It must go to minimum. I should change the quantity of the bonds, non-negative, because I'm not able to buy negative number of bonds, and I am adding the additional assumption. This sum must be not less than this one. And this sum must be not less than this one. And that's all. So I should buy 10 bonds of the first type, and I shouldn't buy no bonds of the second type. This is how to implement the matching strategy. So this is the second part of the case number 2, the matching strategy, which you will use to make funding of immunization strategy when you will implement it in real life. Any questions about this moment? Because I want to go to the risk portfolio. Does somebody want to make a question? Okay, I think it means you don't have any questions. Good. Okay, so now we are ready to go to the risky portfolios. You are ready to form the risky portfolio. Good. You had fixed 7 assets, and I think all of them are shares. And when you're dealing with the risky portfolio, the main characteristics of it will be expected return and risk. Now we will discuss how to estimate them, this expected return and the risk. Okay, let's consider a particular asset. The particular asset in your case, in case number 2, and in the part of the risky portfolio is an ordinary share. The ordinary share has 2 characteristics. It has Okay. First of all, let's consider an ordinary share. So in this case, we have two opportunities. In general, the income of this financial asset consists of two parts. First of all, these are periodic payments. They can happen or not happen. I'm talking about the dividends. And of course, it has change in price in the market. Okay, some assets will never pay dividends. For example, it's a general approach for IT companies. But some companies, actually most of them, will pay dividends. So if we are considering the return without dividends, it will be just change in price, and your formula for calculating the return you can see in the slide. In case we are paying the dividends, the situation will be like this. So here also on the slide you have two examples how it can be calculated in case you are paying the dividends and you will not do it. I want to make the notation, but in case your share will pay dividends, you should add them because we are interested in total return, not change in price. Okay. Also, let's move to the next notation about the return of the ownership. This is also very important characteristic of a particular asset. Return for the period of ownership is a proportional change in the value of the asset measured of a corresponding period and other benefits and holding the asset in a portfolio. Okay, also you have the example on the slide to understand how you should calculate. So here should be equal to calculate. If the change in annual returns equal to 7, 9, and 10%, the total return in 3 years will be equal to 10%. Okay, this is how to estimate the total return for the period of ownership. Any questions? You will not take free bonds. You will take at least 3 bonds to the immunization strategy, and so that your immunization strategy provides rebalancing at least. And the rest part you will put to the matching strategy. So you should divide your bonds into two parts. The first part will go to implementing the immunization strategy, and you should take at least 3 bonds in this part. And the rest of the bonds will go to the matching strategy, which provide the funding of your immunization strategy in real life. Did you understand me? Okay. Uh, Okay, let us suppose that the time horizon of the investment will be equal to T years, and let us suppose that V0 represent our initial sum of the investment. The return of the investment uh, is the number R satisfying the following equality. So after the investment, you get V. At the initial moment of time, you get V0. So this is how to estimate uh, the result of the investment in terms of the return. If you want to calculate the average annual return of investment, you should use this formula. I think it's quite clear. This is how to calculate the average return of investment when calculating interest M times per year. And in case you will consider continuous interest rates, in sometimes it can happen and will be more comfortable, you should use this formula to get the number R was still done. Okay, I think everything is clear about how to estimate. Let's move to the next notation. This is about the expected return. It's possible to apply two approaches to estimate the expected return of the asset. Actually, about the shares. At this moment, I'm talking about only the shares. Let's assume we know the probability distribution function of profitability of our investment in a particular share. In case you know this construction, in case you know the numbers, you can use this. In case you know the probability, you can calculate expected return just using the mathematics you had started a year ago. And to calculate just mathematical expectation. When you calculate the variance, and you will calculate the square root, which will represent the risk on the investment. But this approach you can implement only if you know the distribution function. In real life, you should understand you don't know the distribution function, but it can happen in sometimes you know or you assume the distribution function will have the following form. Okay, if you have it, you will implement this approach to calculate the risk and the expected return of a particular asset. I will show the example. What is this about? What is this slide about? What does it mean? This is about the following construction. Let us suppose we know the distribution function. It means we know the probability of future prices of our share. Let us suppose that the current price of our share is $90 or $80. 90. And we know that with probability of 5%, in a year, it will be equal to 82. With probability of 10%, it will be equal to 90, so it remains the same. With probability of 30%, it grow up to 95. With probability of also 30%, it grow up to 98, and with probability of 0.25%, it will be equal to 100. If we know this distribution function, we can calculate the expected return, but pay attention that these are prices and you need the returns. To calculate the returns, you should apply the formula. You have future payment minus current price divided to the initial price. The initial price will be this one because this is in the very beginning. So you should calculate returns. And to estimate the expected returns, at this moment, it will be equal to mathematical expectation. And to calculate the mathematical expectation, I remind you from the previous year, you should find some of the products of the probabilities to the values. Like this. It means this is the average we are waiting that in a year our share will grow up to 6.7%. This is about the expected return. So how to estimate the risk? To estimate the risk, you should calculate the variance. If you have the probability distribution, you should calculate, first of all, squares of deviation from expected return. So like this. return minus expected return power 2. So to find the variance, you should find sum of the products also, the squares of deviation, also information for previous year, to the probabilities. And to calculate the risk, you should take the square root of it. But this approach works only you have, we don't know how did you get it, but you should have this distribution function. Okay, what should you do in case you don't have the distribution function? In case you don't have the distribution function, you should apply some other models to estimate the expected return. In this case, we will use one model. It's a so-called capital asset pricing model. Capital asset pricing model is the model based on the analysis of the race of the stock market's information and especially on the returns and changes of free floating stocks. By means of what the forecasting of future profitability for the investment portfolio will be made. This approach was developed by Harry Markowitz in 50s of 20th century and finally formed as a model in 60s by William Sharp, Jack Trainer, John Lichtner, and Jan Mosin independently. CAPM models is based on the efficient market hypothesis. Pay attention to this fact. This hypothesis was formulated by Eugene Fama in 60s of 20th century. Also, I think you should read a bit about this efficient market hypothesis. If you don't know what is it about, actually you should know, but maybe you forgot. Да, Шунейкина, не должны повторяться. Okay. In framework of application of the hypothesis, we will have some restrictions of this method. You can see these assumptions or restrictions of the model on the slide right now. First of all, we are assuming the information is available to all the investors. It means there are no market participants who possess inside information and thereby get an advantage in making decisions. Insight is prohibited, so it's absolutely real life assumption. Also, we are supposing the market is perfect, of course, unreal assumption. We have a direct correlation between information about the company and valuation of its assets, of course, real life. We supposing all the investors have long-term investment horizon. Short sales are prohibited here. The assumption guarantees to avoid strong price fluctuation of the assets on the market. Also, we're assuming all the assets have a high liquidity and completely divisible. Unreal assumption. CAPM is the theoretical model. You can find a lot of information about it. You can find a lot of estimation of it. It's bad, bad, and bad. You will find it. But this is the most useful model in the world right now. The most useful. With some adjustments, of course. Let's move to formalization of the models. CAPM model is a linear regression equation which demonstrates the link between the connection between the market returns and the market risk, and it looks like as follows. So here mu will be the expected return, RF is the risk-free rate, In our case, it will be the K rate. B represents the beta coefficients, very important part of this model, which reflects the sensitivity of direction of the market, direction of the market price of the asset on the changes in the market scale. Okay. First, let's discuss how to calculate this rate. In terms, especially in our situation that change significantly. So you should calculate the weighted rate. You can move, for example, here, take like this, for example, in Russian market. Like this. Your time period will be coincide with situation when you had fixed your bond portfolio. For example, it was, I don't know, February 10 to February 10, like this. And you will find the information. You can upload this information from here and calculate the weighted rate. And you will use this weighted rate to calculate RF in real life. Pay attention to the slide, of course. Do not use the rate which we have right now. That is why I have chosen this horizon, because now we have 20% in Russian market, and you shouldn't use it because the calculations will be absolutely impossible to implement in real life. Because now it's 20% and everything is very, very bad. Okay? Okay, no questions. Good. Okay. So you are uploading the information on your asset. You are calculating this. Instead of this, you should use the index to estimate the market. You should use the benchmark of the market. So it means you should use the corresponding index. Any questions? No questions. Okay. Let's move to our portfolio. At this moment, I'm assuming you had calculated the expected return to each portfolio using this model. No problem to do it, because no problem to upload the information on shares. You can calculate the returns. Next, you can calculate the beta coefficient. About beta coefficient, you should know how to explain what did you get. In case the beta is positive, it means that your share moves in the same direction as the market. In case the beta is negative, it means they are moving in opposite directions. In case the beta is less than 1, it means your asset is less risky than the market. More than 1, more risky than the market. In case the beta is equal to 1, it means your asset will make the replica of the market, or it can be explained by the weight of this particular asset in the index. So in case you got the beta is very close to 1, you should study if it represents significantly in the index which you took as a benchmark of the market you are considering. Any questions? As the average RAM, you should calculate as the average value of the returns of the market. You should upload the daily returns for 1 year and the daily change in price, and it will be enough to do it for a year. Like this, for example. So if you want to do like this, you can calculate like this. And if you want to calculate RM, it will be average value like this. Okay. Any questions? No, I can't. The lecture is finished. About beta, you can find the information on electronic resource with a lot of information. The K moment is less than 1 or more than 1, and the sign of the beta, because beta is very important moment. So we will finish this case on the seminar on Saturday. Any more questions? Okay, bye.